Welcome to the Pro Ticker Deep Dive. Today we are focusing on, well, one of the most compelling market stories out there right now, the Japanese equity market. I mean, the Nikkei 225 index has seen this incredible resurgence. It's charged past those bubble era highs from, what, 3 decades ago?
Yeah, it's really forced everyone to sit up and take notice.
Exactly. So it makes you ask the big question, is this just, a temporary spike, part of the global recovery cycle? Or are we actually seeing the start of something bigger, like a whole generational re-rating of Japanese stocks?
That's really the central debate, isn't it, in global markets right now? And what's really grabbing headlines is just the sheer momentum. You've got technical analysts openly talking about the Nikkei maybe pushing towards 46,500.
Wow, 46,500.
A number that honestly would have sounded completely fantastical just 5 years back.
That kind of target suggests real structural confidence, not just a blip.
It does. So our mission today is to get past those headlines and really unpack the big forces driving this. We see three major things: global AI demand, deep corporate structural changes in Japan, and that persistent currency effect. But crucially, we also need to weigh these against the risks, because there are definitely still risks out there.
Okay, let's start with that first driver, the engine for so much right now, technology. AI. We know the rally's been focused around semiconductors, the whole AI ecosystem, but often when you look at that supply chain, the focus immediately jumps to, say, Taiwan or South Korea for the actual chip making. So why is Japan's role so critical here? Why is his market getting such a boost from this? Why is Japan so essential to the AI boom?
Right, and what's fascinating is understanding Japan's specific strategic advantage. When we talk about the AI revolution, the huge spending from NVIDIA, AMD, the cloud giants expanding capacity, they're not just buying finished chips. They need the whole infrastructure to build, test, and package those chips. And Japan is, well, uniquely positioned as kind of the undisputed picks and shovels provider for this AI gold rush.
Ah, okay. So not mining the gold itself, but selling the really high-tech gear needed to mine it.
Exactly that. This AI stuff requires incredibly precise equipment, advanced materials, really rigorous testing capabilities. Only a few companies globally can deliver that at scale. And guess what? A lot of them are concentrated right there in Japan.
Can you give some examples? Who are these key players driving things?
Sure. Look at Tokyo Electron. They're a massive global provider of wafer fab equipment, the machines that actually etch the circuits onto the silicon wafers. Then there's Advantest. They pretty much dominate the very technical field of semiconductor testing. Super critical. I mean, if Japan suddenly stopped making this specialized gear tomorrow, the whole global AI hardware supply chain would face an immediate catastrophe.
And that's the key point, right? The source material really highlights this nuance. While you have fierce competition in maybe the more commoditized parts of chip making elsewhere, Japan's niches in this specialized equipment, the materials, the testing, that makes it less vulnerable.
That specialization is absolutely key. It helps protect their margins. It gives them a kind of insulation from the direct pricing pressures that maybe the core chip makers face. So when global investment flows into the most cutting-edge, mission-critical parts of the supply chain, Japan really benefits disproportionately.
Okay, so that's a powerful global demand story, definitely tied to AI. But, tech cycles can be just that cyclical. For this rally to feel truly structural, something fundamental has to be changing inside Japan. Let's talk about that domestic transformation. For decades, the story about Japanese companies was, well, kind of insular governance, complex shareholdings, hoarding cash instead of boosting return.
Right. Low ROE, lots of cash just sitting there.
How is that story finally changing?
This is the really interesting part, the core structural shift. People are calling it Japan 2.0. And arguably, it's the most important long-term factor here. The pressure isn't just coming from outside investors anymore. It's actually being pushed from within. The Tokyo Stock Exchange, through its reform efforts, has basically changed the rules of the game. They've actively targeted companies, especially those trading below book value, a price-to-book ratio under 1.0, and essentially forced them to improve shareholder returns.
Forced them how? Is it just a suggestion or does it have teeth?
Oh, it's got teeth. It's a direct challenge to decades of corporate habit. Companies now face real pressure to actually spell out concrete plans. How are they going to get their return on equity, their ROE higher? How will they lift that PBR above 1.0? It's aimed squarely at that old resistance to change, making them rethink things like those inefficient cross-shareholdings and, yeah, those massive cash piles.
And we're already seeing results, right? Record stock buybacks, dividend hikes.
Absolutely. A wave of activity.
But I have to ask, is this just, financial engineering to tick a box for the regulators? Or does it signal a real lasting shift towards capital efficiency?
That's the critical question everyone's asking. And while maybe some companies initially used buybacks just to look good, the sheer volume and persistence of this activity, it really suggests a genuine, maybe permanent shift in priorities towards shareholder value. And the immediate effect is clear. Foreign investors who for years saw Japan as inefficient are now piling back in. They seem to believe that this time, the commitment to efficiency is actually real.
So investors aren't just looking at Japan as that old deep value play anymore, like buy companies drowning in cash and just hope they eventually spend it.
Exactly. They're now treating Japan more like a growth plus value hybrid. You get the benefit of that organic growth from the global AI cycle, plus this mandated value unlock driven by the corporate reforms. It's a powerful combination.
And there's still potential left on the table.
For sure. Japanese companies still hold enormous cash reserves. If this regulatory pressure keeps up, and it leads to more actual capital spending on growth projects, or maybe more M&A activity, that could unlock a whole other leg of growth for the index, something beyond just the current AI wave.
Okay, we've got the tech demand covered and the local reform story. The third piece is the macro picture, specifically the currency. The yen has been incredibly weak. How does that weakness translate so directly into soaring profits for exporters? And what's the downside for people living in Japan?
Yeah, the currency acts like this really potent tailwind right now. The yen's weakness is mostly driven by that huge interest rate gap between Japan and the US. US rates are much higher, right?
Right.
So capital flows out of the low-yielding yen into dollar assets. Simple as that.
Yeah.
Now, for Japanese manufacturers listed on the exchange, especially the big exporters with lots of overseas sales, this weak yen is like a massive booster shot to their earnings.
So basically, when they bring their foreign sales, dollars, euros, whatever, back home, it converts into way more yen than it used to.
Precisely. It just inflates their reported earnings in yen terms, often lets them beat analyst forecasts, even if their underlying business growth is just okay. But, like you said, this corporate optimism comes with some pretty significant headaches back home, and that creates potential volatility.
Let's talk risks then, starting with the consumer. Inflation is back in Japan, a country that fought deflation for decades. That must be a shock.
It is. The number one domestic risk is imported inflation. Because the yen is weak, everything Japan imports, energy, raw materials, food, gets significantly more expensive in yen. And that's really squeezing household budgets, testing consumer spending in a way Japanese people haven't really dealt with for, well, decades. If consumers pull back too much because costs are rising, domestic growth could stall out, and that could offset some of those exporter gains.
Okay, consumer risk. What's the second big one? It centers on the Bank of Japan, right? The very institution that created this interest rate gap in the first place.
Exactly. That's a monetary policy risk. The BOJ is, very cautiously, starting to step away from its super loose policies of the last decade or more. They're moving slowly towards normalization.
Yeah.
But this raises that huge debate. If they tighten policy, will that inevitably strengthen the yen? Will bond yields rise?
And a stronger yen would hurt those exporters.
Potentially quite badly. Any aggressive move by the BOJ that pushes the yen up significantly could quickly erode that currency tailwind they rely on. It could potentially derail the whole equity rally. It's a major balancing act.
And the third risk, given Japan's role in that specialized tech supply chain we talked about, geopolitics.
Absolutely cannot ignore that.
Yeah.
The rising tensions between the U.S. and China cast a really long shadow here. Because Japan is such a vital supplier of key semiconductor gear and materials, the risk of those tensions spilling over maybe through trade restrictions or supply disruptions is very real. Any major supply chain shock in Asia would hit the Nikkei almost instantly.
Okay, so we've weighed the three drivers, AI, reform currency, against those three big risks. Domestic inflation, BOJ policy change, and geopolitics. What does this all mean when you look at the charts? Let's talk about that specific technical target everyone's mentioning, 46,500. Where does that number even come from?
Well, the chart itself tells a pretty compelling story. It looks like structural momentum, not just, temporary excitement. Breaking past those 1989 bubble highs wasn't just psychological. Technically, it was a huge breakout from a resistance zone that held for decades.
A major consolidation ending.
Right. And when something that big breaks, technical analysts start looking for the next logical target based on past patterns. That 46,500 number. It's derived from standard technical methods, mostly Fibonacci projections and what they call measured move analysis, calculated from the size of the last major breakout move. Assuming the current structural forces hold, it's seen as a compelling, mathematically derived potential destination.
What other technical signals are traders looking at that suggest this move has conviction, that it isn't fragile?
Well, we've seen pretty healthy volume coming in on the breakout, which adds confidence. It suggests broad participation, not just a few speculators jumping in. And, importantly, the moving averages are still looking very bullishly aligned. The 50-day average is sitting comfortably above the longer-term 200-day average. That's a classic sign of sustained underlying strength.
But markets don't go straight up. If we do get a pullback, a healthy correction, where are the key levels people might look to buy? Where might they show conviction in the longer-term story?
Yeah, traders are definitely watching key support zones. If we pull back, you'd expect strong buyer interest to potentially emerge around the 36,500 level. If there's a deeper correction, the next major support zone looks to be down near 33,000. These are basically price areas where buyers showed up strongly before. So look, while you always have to be cautious short-term, things might be a bit overbought after such a sharp run-up. The bigger picture, the structural backdrop, still suggests momentum favors more upside, as long as those key support levels hold firm.
So let's try and summarize the big theme here. Japan is definitely back in the global spotlight. And this current momentum, it feels genuinely structural this time. It's like you've got this massive global AI story colliding with an unprecedented local corporate reform story, and it's all currently getting an extra boost from that weak yen.
Hmm.
It feels like a fundamentally different setup than the Japan we saw during the lost decades. Maybe this really is Japan 2.0 leaner, more focused on shareholder value, and plugged right into the core of the future global economy.
I think that captures it well. And maybe the ultimate question for you, the listener, isn't just is Japan back, but more, how sustainable is this rally,
Hmm.
especially if global volatility picks up? Or, perhaps more critically, what happens if valuations start to run ahead faster than actual corporate earnings can keep up? That balance between the hype and the disciplined execution on reforms and earnings, that's likely going to determine whether 46,500 is just a milestone on the way higher, or if it turns out to be the next big psychological peak. Something to think about.
See you all in the next Pro Ticker Deep Dive.